Good afternoon, everyone, and thanks for making time in your March Madness viewing and for joining us today for our CRE CLO webinar. I'm Steve Jellinek, and I head up DBRS Morningstar's CMBS North American research efforts. DBRS Morningstar recently published our fourth quarter CRE CLO quarterly report. Today's webinar features the two primary authors of this commentary, John Amman, Senior VP in our new issue group, and Stephen Koehler, Vice President who heads up our CRE CLO surveillance efforts. In today's webinar, we're going to discuss market updates on volume, trends, outlook, and all topics covered in our quarterly report. We're also going to dig deeper into business plans, upcoming maturities, and loans and extension periods. And just so everybody knows, we'll be discussing, and all the slides are going to cover, unless we mention otherwise, the entire CLO universe, unless we otherwise note that. So let's kick this off. Turning to John. John, can you tell us how the CRE CLO ended in 2022? What was the volume and what was the breakdown between managed and static deal types?
Yeah, sure. Thanks, Steve, and welcome everyone to the webinar. So yeah, let's get started and take a look at CRE CLO issuance. What you can see in this table is the CRE CLO quarterly volume from 2020 to the first quarter of 2022. The bar chart shows the volume and the line shows deal count. If you look just at 2022, which is kind of sort of the right side of the table, what you can see is a year of two halves. We really started out the year running at a ferocious clip in the first quarter, which was coming off a very strong end of the year in 2021. And the 2022 first quarter hit a record high CRE CLO issuance of $15.3 billion, coming from an impressive 13 deals. That's really a lot of deals. And just to repeat that volume again, it's a pretty astounding figure, $15.3 billion in a single quarter. But the second quarter saw a seismic shift with Russia's invasion of Ukraine and CPI prints that hit a recent record of 9.1% in June. The runaway inflation could no longer be ignored by the Fed, and they had to abandon their transitory stance and instead quickly adopted a restrictive monetary policy with unprecedented interest rate increases and a plan to reduce its balance sheet. The C-shift change quickly put the entire real estate market back on its heels, and throughout much of the third and fourth quarter of the year, the industry had to recalibrate models to account for the higher interest rate environments and rising cap rates, which ultimately pushed values down and slowed acquisitions. The quickest ascent of short-term interest rates put an immediate strain on CRE CLO loans, which are floating rate by nature and tied to the SOFR index. To put the spike in interest rates in perspective, in 2021, competitive multifamily interest rates bottomed at sub 3% interest rates, although they averaged closer to 4%. Compare this to late 2022, when competitive multifamily interest rates were closer to 7.5% to 8%. The difference in rates reflects this index moving from a near 0% in 2021 to the more recent mid 4%. So you can clearly see that the higher cost of debt really needed to be considered by property investors and will continue to be under scrutiny for the foreseeable future as the Fed continues to contemplate future rate increases. So looking back at the table, you can see that the issuance in the third and fourth quarter of 2022 really dropped, with only 4 deals in Q3 and then 3 deals in Q4. The year did end with the second highest issuance on record at $30.3 billion and was really buoyed by that strong front half of the year and that massive first quarter with over $15 billion of issuance. So wanted to pause there and see if we can initiate a poll here and get some ideas from you all with regard to when do you guys think CRE CLO issuance will return to quote unquote normal. The options that we have up here on the screen lay out kind of on a quarterly nature. When will this happen? So I've got third quarter of 2023, the fourth quarter of 2023, first quarter of 2024, second quarter of 2024. And then our last option is never. I mean, has the CRE CLO market completely died and it's never going to come back? So we'd love to hear from you guys, and I'll just give this a minute to see if we can get some responses in the poll, which I hope is still is working here. There's got a little bit of a countdown, so I'm seeing some results come in. Thanks for responding. And I think we all wish it would happen sooner than later, but let's see what the group says. So, I'm going to end the poll here. What you guys should hopefully see, I don't know if this is coming up on your side, but it's actually somewhat evenly split. I'm seeing 20% of you responded that the third quarter we'd see a comeback, 20% also in the fourth quarter, and the bulk of the majority is in the first quarter of 2024, when I see 32% of you thought that that might be when we come back to normal, and the second quarter actually the second highest at 28%. I guess a good thing, nobody said that the market's dead. So, we all expect this to pick up eventually. And I think this is consistent kind of what we've been hearing in the marketplace. So thanks for responding on that. Steve, you also had asked about the deal types, and what we saw was a meaningful shift throughout the year. And just to back up, as far as the deal types, static deals refer to deals where the collateral is fully identified at closing. So the deal may have 20 loans at issuance, and those are the only loans that can be part of the deal. Contrast that with managed deals, where the deal allows for new loans to be added to the transaction after closing during a ramp-up period and or a reinvestment period. In a managed deal, when a loan pays off during the reinvestment period, the principal proceeds could be reinvested into new loans and brought into the trust. The market generally views managed deals as having more uncertainty, given that the collateral manager is allowed to bring new loans into the trust, and the new loans may have different credit characteristics than the existing pool. However, there are some mitigants to managed deals. First being that new loans must follow deal-specific eligibility criteria that lays out property type constraints, LTV maximums, DSCR minimums, and diversity requirements. In addition, for deals rated by DBRS Morningstar, the issuer is required to obtain a rating agency confirmation, and this means that DBRS Morningstar reviews each new loan and assesses if the addition of the loan would result in a rating downgrade. Now, getting back to the deal types and breakdown in 2022, what we saw was a higher market tolerance for managed deals at the beginning of the year, which in the first quarter saw 85% of the deals as managed and only 15% as static. Throughout the year, though, the deal composition shifted more towards static, and by the fourth quarter, the deals were split 33% as managed and 66% as static. The shift was a reaction to the changing market conditions and bond pricing in the marketplace. The same trend was also evident during the onset of the pandemic in 2020, when issuers also shifted from managed to static transactions.
Thanks, John. Sure, most folks want to know what we think about what's going to happen in 2023. So what can you tell us about new loan originations and CRE CLO new issuance forecasts for 23?
Yeah, sure. So in our conversations with issuers, they reported really a significant slowdown in new loan opportunities beginning in the second half of 2022. And unfortunately, that trend has continued into early 2023. For some lenders, this has meant a near shutdown in new loan originations, with only a handful of new loans in the latter part of 2022. For other lenders, however, they do report being active in the market, although there's just far fewer deals to pick from. The decline in origination can be traced to the sharp increase in interest rates, capital markets volatility, and far fewer property acquisitions. Specific to that last point, property acquisitions, the feedback that we've heard is that borrowers are taking a wait-and-see approach, which we don't really know how long that could take, but it could take several quarters, and they'd reemerge only when there's signs of market stabilization. This is particularly unfortunate for the CRE CLO market in particular, as new issuance is typically fueled by property acquisitions, where borrowers acquire properties with a business plan to transition the asset and refinance it into permanent debt. For the foreseeable future, lenders anticipate far fewer lending opportunities, with many respondents expecting activity to come from borrowers needing rescue capital to adjust pending maturities or property acquisitions, albeit at a much lower volume. When identifying new loan opportunities, lenders continue to favor multifamily properties, which have the most stable fundamentals. The property type least in favor is office, which I feel like that's all we kind of hear about right now. And that property type is coming under intense scrutiny. Credit concerns for office include a secular change of lower tenant utilization as a result of employers offering hybrid work weeks. In addition, for office loans we've reviewed, if a tenant has a near-term expiration, the recent trend is that tenant may be more susceptible to downsizing or vacating altogether. Landlords are also facing astronomical tenant improvement costs and offering considerable free rent to attract and retain tenants. Our team has also seen a lot of tenants exercising early termination options or subleasing space, causing further credit deterioration. Despite that negative outlook for new loan origination in 2023, the lenders we spoke to were surprisingly optimistic, or maybe that's not that surprising. We all have to have kind of a positive spin on things. And most of them targeted origination volume similar to 2022. All lenders agreed that the start of 2023 will have a low volume, but expected interest rates and values to stabilize throughout the year, allowing for volume to increase in the second half of the year. And I think that's pretty consistent with the poll results, which really saw end of the year into early 2024. Steve, with regard to the CRE CLO issuance specifically, 2023 is off to a really slow start. We have it in the slide here. You can see that there's only been 2 deals issued in the first quarter. We're wrapping up the first quarter now, and that's where it looks like we're going to end at, with volume of $1.1 billion. Now, if you look back at the issuance table, you'd see that you'd have to go back to the depths of COVID or the third quarter of 2020 to see such a low quarterly issuance figure. Going into the second quarter of 2023, the upcoming quarter, the programmatic issuers that we spoke to said that they would like to get a deal out in the second quarter, but these ambitions could be constrained by slow loan origination pipelines and the ability to aggregate a sufficient amount of collateral to launch a deal. Issuers remain hopeful, though, that the market does find its footing in the second half of the year and issuance becomes more regular. If issuers can get deals to market, they could find favorable demand from investors that now are obviously starved for CMBS issuance because there's just not much out there. And this could ultimately help with deal pricing. So that's one sign of positive. In order to see the market return, the obvious answer is that we need to see interest rates come down and for acquisitions to make a meaningful comeback. The question really becomes, how long will that process take? And while we don't have a crystal ball over here at DBRS Morningstar, we do, our prediction is that the CRE CLO issuance won't snap back in 2023. And our estimate is that issuance in 2023 will end up just below $18 billion, which represents an approximate 40% drop from last year and a 60% decline from the 2021 record issuance of $45.4 billion. So putting that back together, that's potentially only $18 billion of issuance in 2023 over the entire year. And just thinking back to that first quarter of 2022, we had $15 billion. So really, stark contrast in volume there. So why don't we go to our second polling question? And we'd like to ask you guys, let me see, get this started. What do you guys think about issuance? What's your forecast for 2023 CRE CLO issuance? Hopefully you guys see this on your side. The options would be less than $15 billion, between 15 and 20 billion, between 20 and 25 billion, and between 25 and 30 billion, and then greater than 30 billion. So we'll just give that a few minutes to register, see if we've got any bears or bulls on this. I think it could be tough to kind of hit that upper end, but we'll see what happens. So we'll give this a few more minutes and let everyone respond. I'm seeing some of the initial results here. I'm actually a little surprised. And it was interesting. I was looking back at the CMA. There was, a lot of, there was some estimates at the beginning of the year, and I'd say our $18 billion number was on the very low end of the poll results in that survey. So as I'm looking at I'm going to end it now, and the poll results here, what I'm seeing is very much a low end issuance. I see the largest being 48% at less than $15 billion. So not even hitting, I guess, where we thought we might end the year. And then the second one followed at $15 to $20 billion. So, it seems like the consensus here is that we're going to have pretty low issuance going into 2023. But, despite that drop in volume, A few encouraging takeaways I'd like to emphasize is that the CRE CLO market has definitely matured in recent years, as evidenced by the high deal volume, even surpassing conduit issuance in 2021 and 2022. Also, there's considerable pent-up demand to invest in real estate and plenty of dry powder to put to work on the debt and equity side. So when the market does stabilize and rates come down, we may be in for a relatively quick snapback and a flurry of deals hopefully materialize as a result. From an investor side too, the broader acceptance by the market and investors can be attributed to investor-friendly structure for CRE CLOs, which includes interest coverage tests, over-collateralization, and maybe the most important consideration is risk retention by the issuer, as they typically hold the most subordinate portion of the capital structure, which can be between 15 and 20% of the deal. We'll ultimately see over the next couple of quarters if these structures hold up and protect the investment-grade investors, but the long-term outlooks do remain optimistic.
All right, fantastic. That was a really good overview and gave us some good context into what we expect in terms of overall issuance. Digging a little deeper, can you tell us about the property types contributed into CRE CLOs and any recent changes to the compositions?
Yeah, absolutely. So look, we flipped it to the next slide here. What you see here is the quarterly volume composition by property type. What immediately jumps out is that multifamily loans make up the majority of the loans contributed to the deals. That's the blue bar. That's obviously the highest in the table. You can see that the percent of multifamily loans has steadily increased from 50% approximately in early 2020 to as high as 80% in the third quarter of 2022. The increase in multifamily loans corresponds very closely to the decrease in office loans. And you can see that in the table as the Q3 2021, pretty significant drop. It had been running at 20% or so of deals with office composition, and that's really kind of bottomed out. This trend is, really is no surprise given just the difficulties that we're seeing in offices. However, as Steven will touch on later, and people can read about in our surveillance performance reports on DBRSMorningstar.com, certain existing CRE CLO deals do have office exposure. This is the seasoned deals, and this is an area where we're seeing stress as sponsors are unable to increase occupancy to the projected levels. In fact, in several seasoned deals that had a mix of underlying property types, it's common to see most of the multifamily loans actually pay off, and the remaining loans in the deal are heavily concentrated with offices. In the table, you can also see that hotels, which is the green bar, it's a relatively small percent of loans that come in the deals, but we did see a somewhat sizable increase in that in the most recent quarters, and it's remained higher than its historical average.
That's really good information on property type, John. Thanks. Switching a little bit to underwriting trends, can you tell us about underwriting trends in CRE CLOs? As you mentioned, multifamily loans have predominantly making up CLO deals. What are you seeing specific to that property type?
Yeah, sure. So the overall credit sentiment that we heard from lenders is just a state of cautious, with most pulling back on leverage and emphasizing the strength and experience of the sponsors. There's also additional loan structure that may be incorporated, which could come in the form of larger interest reserves, in-the-money interest rate caps, or additional guarantees. These turbulent times have also elongated the loan application process, which also introduces just more uncertainty in loans closing. Within the multifamily property sector specifically, we are seeing rent growth cooling off, especially in the Sun Belt markets, although upside may still exist from the loss to lease phenomenon or the ability of the landlords to increase in-place rents to higher market rents. I'm particularly concerned with bad debt, which we've seen remain elevated since the pandemic. It hasn't really, fallen back down to pre-pandemic levels. And given the ongoing macroeconomic volatility and eviction moratoriums ending, this may continue to be an issue that we want to keep an eye out for. In our underwriting of CRE CLO loans, we're always asking for updated business plans and updated rent rolls. This information is critical in our analysis, especially on our ability to accept rent premiums or lean into the occupancy. And as a reminder, in our underwriting, we do not accept future rent growth in and of itself in our stabilized analysis, but what we do accept is rent premiums that are tied to specific investments to the properties, generally in the form of unit upgrades. And then with regard to expenses for multifamily properties, I mean, obviously there's a backdrop of just significant inflation coming through the economy, and we have started to notice increases to certain line items, and I'll just point those out, including insurance, repairs and maintenance, payroll, and general administrative expenses. Unfortunately, it's almost like most of the line items are increasing more than they historically had. It really seems like the one line item that we've noticed some declines is marketing and advertising expenses, and that's probably just sponsors cutting costs where they can. So that might be the reason that that's actually coming down.
Sure. Your discussion on expenses and line items and inflation makes me think of business plans. And I'm sure a lot of our listeners have the same thought, like what's happening with business plans. Steven, can you tell us about the typical business plans for CRE CLOs and any updates on how they're going?
Yeah, absolutely. Thanks, Steve. So I think we'll start there with multifamily properties. So if you could jump to the next slide, we'll kind of go over the three general business plans that we see across the multifamily sector. So let's just start off with the initial lease up of new construction. So kind of speaks for itself. The plan here, limited future funding on these loans, potentially only would be as a debt service reserve. So these business plans are still viable in core markets. Your New York City, for example, or other East Coast big markets, and then additionally in some high growth secondary markets, Austin, Texas, Nashville, just as an example. So these business plans are generally moving forward as planned. The only thing that we are noticing is that the lease up phase may be taking a little bit longer. So you might just see more concessions or concessions taking longer to burn off. But generally, this property type and this business plan is progressing as expected. So moving down to the heavy turns of multifamily. So the best way to think of this is essentially transitioning from one class to another. So taking a Class B property to a Class A or a Class C to a Class B. So the investment here is, complete gut rehab of the interiors. The finishes are going to be a step up. The amenities are going to be a step up. And when you're doing that, you're looking, at spending $20,000 or more just on the interiors of the units. So some of the challenges that we've seen recently, I think the concerns with supply chain disruption has tended to slow down, but more so, when you're spending this amount of money, there's a certain return on investment that sponsors are looking for. So with the expectation that rent growth is just going to slow down generally, when the $500, $600, $700 rent premiums that a lot of sponsors are expecting when you invest this amount of capital, that may be a little bit more challenging moving forward. And then lastly, the light turn business plan, which is far and away the most common one that we see, those are tending to progress as planned as well. So here, the interior unit investment, plus or minus $5,000, excuse me. And that's a more programmatic, replacement of appliances, replacement of lighting, plumbing fixtures, flooring. And so when you've got, sponsors that have big portfolios, sponsors that have done this many times over in many different markets, sometimes the sponsor with, a footprint in a particular market, whether that's in the Sun Belt, in the Southeast, different markets across Texas. This is a business plan that we see most often. It's been most successful. These rent premium targets of $200 to $300 are easier for tenants to absorb. I know there are concerns with just housing affordability nationwide, but this rent premium is one that we are seeing being achieved more easily. And so moving forward, the rent growth, that John mentioned, that we don't just recognize upfront, that 10%, that 15% year-over-year rent growth that was seen in markets like Tampa or Phoenix, we expect that to cool off. The more normalized 2 to 3% annual rent growth is something that I think is what we're going to see moving forward. So moving from the least, or from the most favorable property type to the least favorable property type, we'll jump to office. So some of the updates that we're generally seeing with office properties is that the initial business plans, they tend to kind of be similar, do some capital improvements across the property, and then fund leasing costs. So the future funding that's been released more generally to date related to capital improvements, improving the building systems, upgrading lobbies, potentially upgrading tenant amenities, those dollars are being advanced to borrowers and they are completing those work items. But where we're seeing issues towards the stabilization process is that there just aren't tenants that are willing to come take big blocks of space. So, the structural vacancies across certain markets. We sit in Chicago, John and myself, and the Chicago Loop submarket seems that it's had a 20% vacancy rate or higher for many years now. We've looked at deals recently, suburban Phoenix or Cleveland, even markets, some markets in DC or New York. There's just a vacancy number that's not really coming down since the pandemic. And despite the fact that there may be significant future funding available for some of these borrowers to fund leasing costs, if there aren't tenants to come take those leases, to utilize those leasing costs to fund build outs, it might not matter at the end of the day. So something that we're seeing with those more seasoned transactions, loans originating in 2019 or 2020, those loans might be approaching a forced funding date. So what that means is borrowers will have to choose, do we want to still be able to access additional future funding that has yet to be advanced? And if they do, the lender may place those funds in an interest-bearing account, or the borrowers could similarly just decline the right to get those funds, at which point they would need to fund any leasing costs out of pocket. The one aspect of office properties where we are seeing some potential positive leasing activity is the construction of speculative suites. So, John mentioned, leases that are rolling, tenants might want to downsize. So there is an opportunity with leases for smaller spaces where tenants might not have to sign up for, 5-7 year lease. They don't necessarily have to put in a significant amount of dollars of their own money. So these smaller spaces are more attractive to smaller tenants, which may desire shorter lease terms. So there are some potential opportunities there, but when you're looking at office properties that have 300,000-400,000 square feet potentially, these smaller spec suites, they don't generate a huge bang for your buck on the bottom line cash flow. So moving to hotel loans, this is another positive property type. As I think most people are familiar with, the borrowers or the hotel loan performance has generally improved to pre-pandemic levels across the country, whether it being business hotels, whether it's like leisure travel, ADR and occupancy penetrations across the industry are generally over 100%. All-time highs in ADRs in some cases. Borrowers have been able to complete PIP upgrades. Operations are stabilizing. So this kind of follows the narrative John noted, where we've seen some more hotel loans come into deals, and makes sense just given how the sector has just improved in the last year plus. So the only potential headline risk I could see here is if there is an economic slowdown, that does limit disposable income, whether that be for you and me for leisure travel, or as companies would tighten the pocketbook a little bit for business travel. And then I'll pass it back to you, Steve, and I think you and John are going to go over some valuation trends that we're seeing across the sector.
Yep. Thanks, Stephen. Appreciate it. I just wanted to a couple housekeeping things. We have a question icon on the screen if folks like to submit any questions, and we will be distributing the slides after the presentation. So, John, back to you. Can you tell us about valuation and appraisal trends?
Sure. Yeah. Thanks, Steve. Not great news here, but we'll go through it. So the slowdown in acquisition loans has made it difficult for the market to peg CRE values. Live deals are being retraded, and in some cases, price reductions are above 15%. On currently marketed deals, lenders report a large bid-ask spread holding transactions up, and I think we all know it's ultimately going to be the seller who's going to need to accept a lower price. Furthermore, although the volume of property sales has dropped quite a bit, there's evidence that the property cap rates are widening out. The consensus from our discussions with market participants is that cap rates have widened out anywhere from 50 to 200 basis points, and values have broadly declined 10 to 25%. Based on recent appraisals that we've been able to review, the appraisers are definitely taking into consideration the changes to the market, and the areas that we're seeing that it's actually coming through on cash flows, specifically when there's a DCF approach, is reducing the rent growth projections forward-looking. They're increasing expense inflation in the near term, and ultimately they're increasing cap rates. So these emerging challenges are broadly lowering values across property types and markets. What we have up on the slide deck now is Green Street's Commercial Property Price Index, which tracks appraised values of properties owned by REITs. And it's kind of like their, I think, monthly reporting of the appraised value. So it's a property to property kind of apples to apples comparison. It's really a reflection of how appraisers are looking at the values on the same property. But what you can see in here is that at the end of February, overall property values were down 15% from the March 2022 peak. And in the past 12 months, you can see that apartments have experienced a significant value decline, averaging 21%. I was somewhat surprised by that value decline, and I'm just kind of wondering if maybe because this index is tied to REITs and likely Class A apartments, they may be experiencing more value declines for the higher end apartments, which could be more pronounced than the Class B apartments that we typically see in CRE CLO transactions. At least that's what I'm hoping, at least, that the Class B is probably holding up value maybe a little bit better. Also, you can see in this table that the office sector is continuing to rack up sizable value declines. In the February data alone, they showed a staggering 9.5% value decline from the prior month. And that ultimately puts the 12-month value decline for offices at 25%. So, really overall, it's not a very pretty picture for property values. And, the jury's out if we've kind of, hit that bottom or not, but hopefully they don't go down much more for much longer.
Yeah, time will only tell if we'll see a spring thaw. Okay, so transitioning to surveillance. Stephen, as we do transition to surveillance, what can you tell us about what we saw related to rampant reinvestment activity in 2022?
Yeah, thanks, Steve. So as I kind of go through this, I think it'll kind of touch on some of the narratives that John has already talked about, similar to loans in newly issued deals. So looked at some of the data here, and throughout 2022, 604 loans were added to existing transactions. So of those, no surprise, multifamily assets were buying away the largest segment of that at 457 loans. And then, followed in a way distant second and third place, office and hotel assets. So through February 2023 reporting, 522 of those loans totaling $10.2 billion were outstanding. So there had been, 82 loans had repaid. So that doesn't necessarily mean that loans were only originated for less than a year before repaying. A lot of times transactions may collapse and seasoned loans are brought into existing transactions. But within that $10.2 billion of outstanding collateral, 400 of those loans, 7.9 billion are multifamily assets. And then you've got about 500 million of office collateral, 585 million of hotel collateral. And then the fourth place property type was healthcare at $527 million. So that sounds like a lot just for that property type, but out of that, 443 million of the 527 million was added to a healthcare only transaction. So that kind of, separates it out a little bit there. So regarding kind of the pace of the reinvestment, I think that's always interesting to look at as well. So in Q1, John mentioned the $15 billion of new issuance, but in terms of the reinvestment loans that came into existing transactions, there's $4.2 billion. So if you're looking at the 10.2 outstanding right now, 40% of that was contributed in Q1, and of that $4.2 billion that was contributed, 3.2 billion of that was multifamily. So roughly 75% of the newly contributed loans. And so as we kind of go quickly down quarter by quarter here, in the interest of time, Q2, the additional collateral was 113 loans totaling 2.1 billion. So we went from 4.2 billion in Q1 2022 down to 2.1 billion in Q2. So, essentially half just in one quarter to the next, as we saw kind of the macroeconomic and world changes occur from Q1 to Q2. Moving, and then, Q3, it was 1.9 billion. Q4, it was 1.9 billion. So, pretty consistent the remainder of the year after Q1. And again, multifamily was by far and away the biggest property type. So in Q2, it was 1.6 billion of the 2.1. In Q3, it was 1.6 billion of the 1.9. And in Q4, it was 1.5 billion out of the 1.9 billion. So very consistently, 75 to 80% of all the new loans that were coming into these transactions were secured by multifamily collateral.
Okay.
So
are you seeing?
Go ahead.
Are you seeing any differences in the performance or transaction composition between managed and static deals?
Yes, absolutely. So if we jumped one more slide, please, we can kind of look at some of these overarching statistics for the managed versus static deals. So, not getting into necessarily the nitty gritty here on the slide, but I think the takeaways here that I see, you've got 52 transactions, with an outstanding bond balance of 52.2 billion. And of that, you've got about 1,700 loans totaling 51.2 billion. So there's $1 billion of available cash in these managed deals as of the end of February. So, that kind of potentially touches on one of the themes that John noted, where just origination volumes are a little slower depending on which issuer you talk to, because there is that $1 billion of cash that is available to fund new loans. And then when you kind of look at the static deals, you're seeing 32.9 billion of existing bonds versus 32.8 billion of cumulative loan principal. So that's only $100 million of available cash. So as borrowers are continuing to receive future funding proceeds from issuers, the issuers are putting in that advanced future funding into the trust through loan participations. So there's just less available cash that is idle in the static deals versus the managed deals. And then I guess looking a little bit at the property concentrations, in both managed versus static, multifamily continues to be the majority of the collateral. However, when you start looking at the second, third and fourth property types, you can see that, office collateral is a much higher portion across the static deals than it is in managed deals. And so, this makes sense. multifamily properties are stabilizing, potentially they're refinancing, potentially the sponsors are able to sell the assets. But once those properties are no longer in a static deal, you're left with, the traditional real estate or commercial real estate properties of, office, hotel, mixed use, retail. And those, we're seeing in our rated book, these seasoned transactions, originated in 2019, 2020, the office concentration in those deals, maybe at origination, it's, 10, 20%, and now we're seeing 30, 40, 50, sometimes even higher percent as the outstanding collateral in a given deal. So we kind of get this adverse selection in static deals now. And, when we're looking at office particularly, and we're seeing select loans, they're not able to lease up to a stabilized occupancy rate, market vacancy rates are really high. We're taking a closer look at, the projected stabilized valuations, and we're taking a look at the as-is valuations. And sometimes these appraised values are from, up to 2-3 years ago when loans were originated. And, we are doing our own kind of internal value calculations to see where we think properties currently would trade. So, we're taking a really close look at those office deals. But contrary, we also have the pay down of bonds. So the existing bonds may have higher credit enhancement. So that's helping to neutralize potentially some of the overall rating risk or in these transactions, because you've got higher credit enhancement to the bonds, which help to insulate maybe a less favorable property type concentration in these transactions.
Okay, if we could take a look at loan performance, what kind of trends are you seeing in delinquency?
Yes, so I think, maybe in the interest of time, I'll kind of be more general in here, but, we're seeing slight quarter-over-quarter increases in loan delinquencies. So Q4 ended at 2.6%, and that was up 95 bips from Q3. So if you toggle to the next slide, you can kind of see a property by property type breakdown. So you see like some big numbers jump out at you, like hotel, it went to 7.6%. The previous quarter is 4.2%. Mixed use up 10%. Office up over 2%. And so, that kind of looks alarming. But when we looked into kind of the individual loans that were being flagged as delinquent, it looks like there's a lot of large loans that are kind of driving the increase in the individual property type rates. So for example, looking at hotels, quarter Q4 versus Q3, there were only 3 new delinquencies. However, one of those is secured by one of those loans is $158 million, secured by a hotel in Hawaii. So that kind of drives that rate forward. Mixed use, there was a $227 million loan. And then with office, there were 18 new loans that were flagged between the 2 quarters, and that totaled $862 million. However, 2 large loans located in Chicago, one loan was located in Long Island City, and one of those loans in Chicago is $250 million. So, the large kind of jump in the property type specific delinquency rate, it's kind of eye-catching, but when you're kind of seeing that it's not necessarily a whole sector issue, it might just be an individual property issue or loan issue. It's not as concerning, but I do think, as loans are potentially coming up for maturity, we might see some flags for maturity defaults as borrowers and lenders work to solve those delinquencies.
Okay, thanks. And looking at special servicing, are we seeing the same kinds of trends in special servicing as we are in delinquencies?
Yes, we are. So here, special servicing rate is pretty modest. We're at 0.6%, and that's just up 11 basis points from the previous quarter. So again, looking at the next slide, you can kind of see the property by type breakdown here. And it's interesting between looking at, specialty service loans and some of the loans that are flagged for delinquency, you get some crossover. So you see the delinquency rate is certainly much more elevated than it is for the special servicing rate, but we did see some crossover amongst loans. And what that kind of tells me is that loans might be delinquent for a shorter period of time, but they're not to the point where the servicer is transferring them to special servicing. We're seeing some more hands-on approach between borrowers and lenders to potentially extend the loans or just work out the loans much more quickly than having them transfer to special servicing. So yeah, the example that I noticed within our own rated book, there were some loans that were flagged in this December reporting for especially service and delinquent, but I know within the past 2 months of 2023, those loans were able to pay out of those pools. So they were just kind of temporary delinquencies, a temporary transfer to special servicing.
And moving on to modifications. What are we seeing there?
Yeah, so similar narrative, and that's the rate increased quarter over quarter. So the overall rate is up to 5.5%, and that equals, what was it, $4.5 billion. So in Q3, the total UPB on those modified loans was $3.4 billion. So quite an increase when you just look at the dollar volume. So looking at the property types, there was a $500 million increase on multifamily loans, $200 million increase on hotel loans, $240 million on mixed-use properties. Office, actually, there was not a huge increase in modified loans. It went from $1.25 billion to $1.37 billion. So I think when I'm looking at these different numbers across these different property types, it shows to me that the upcoming maturities on some of these loans is what's necessitating the modifications. So of these, there are 80 loans out of these modified loan buckets totaling $2.7 billion that are flagged as in their extension periods. And it's interesting to me when I kind of break that down to how these loans are categorized by the servicer for the modification reason. So of those 80 loans that are currently in extension, only 36 of those loans was the modification category maturity extension. So there's not necessarily overarching themes across the different property types. And it is interesting to me seeing how the servicer is categorizing loans across all these different buckets. So, I guess the overarching theme is that there is an increase in loan modifications, but how they're being categorized is tough to pin down sometimes. So of that $4.5 billion, $2 billion was, termed as other, $1.45 billion termed as maturity extension, and then you've got another $700 million termed as combination. So I think there's, a little bit of due diligence that we need to do on our part to kind of figure out what exactly is going on with the modification, what are the terms being discussed, and that's just something that will be continued to be plugged in on. Yeah,
and maturing loans are on top of everybody's mind, I'm sure. What do you think? And you mentioned that in the modification profile when you mentioned modified mature loans. What's the maturity profile look for 2023?
Yeah, so 2023 is a pretty active year for loan maturity. So you see at the top of this pie chart here, 858 loans totaling $23.7 billion. And that makes sense if because issuance in 2021 was so high, and a lot of the terms on these loans might be 2 years with extension options, or loans that originate in 2020, 3 years with terms with extension options. So a big maturity profile, and as we kind of mentioned earlier, with the macroeconomic environment with interest rates and cap rates, it'll be interesting to see, how many loans will be able to pay out of the pools. I think, looking at the property type concentration, it's always going to be multifamily. That's $11.7 billion, and then maybe the more headline risk is that 29% of office, so that's $6.7 billion across 193 loans. Kind of given the theme of office that we generally discuss, the general pessimistic theme, I think that's going to be the more challenging property type. So that's where we're going to be really earning our stripes on the surveillance side, trying to do our best predictions on the office collateral.
Okay, well, thank you very much. Turning to some questions, we still have about a little less than 10 minutes left. I can try and get some questions answered. Are either of you seeing new issuers enter the market?
Yes, Steve. So I'd say we saw a lot of activity or inquiries in 2021 when the pipeline was really robust. I think people were looking from the outside, seeing this very active market, and starting to dip their toe into potentially issuing CRE CLOs. So we had several conversations with new potential entrants in 2021 and maybe early 2022. But I'd say it was mostly the conversations and getting them familiar with the rating agency process and kind of what it would look like. And because of the really sharp shutdown in the market, and leading into after the second quarter of 2022, I think a lot of those potential deals from new issuers kind of got mothballed, and those might come back maybe in the near future if things improve. But there was a lot of kind of inquiries, and we definitely had several conversations with new issuers. I'd say, and we're even to today, we're still seeing some of that activity, which is promising. I think that's another optimistic sign for the market.
Thanks, John. Are there any property types, any new property types that you're seeing enter the CRE CLO space?
Yeah, Steven, I can maybe start on that one. I would say there's definitely some newer stuff. Generally it's the main food groups, but I'd say within the multifamily sector, we are seeing larger loans on mobile home communities, which it's kind of always been in the space, but I think the number of them and maybe the size of those loans is something that has been relatively recent. The build for rent product, which again also falls within multifamily, is I think another growing segment. And those ones are usually more of the development coming out of development into stabilization from a business plan perspective. Whereas the mobile home communities, those ones are generally more existing mobile home communities with a new sponsor coming in to reposition, increase rents, maybe add homes to sites. So that's definitely, I'd say those are probably the two that come to mind for me. Every once in a while we'll see self-storage, and we will see not too frequently industrial, but that's also in some of the more recent mix of deals that I've been seeing.
Yeah, I would echo that same sentiment. Not necessarily new property types, but the number of MHC or the build to rent, those, the pace of those seem to be increasing. But it still seems like every 4 out of 5 is garden-style multifamily on the reinvestment side, but you do see a little bit of an increase on MHC, certainly.
Okay, thanks, guys. One last question. Steven, can you wrap up your expectations for 2023 on the surveillance side?
Yes. So, I think I may have neglected kind of to go over kind of our expectations, on those maturing loans. Certainly given kind of where we are, with interest rates and cap rates and just property trades not being as favorable, what does that mean for these maturing loans? So, a lot of the loans have extension options, but not all of these properties are going to meet those performance-based tests. Usually those are minimum debt yield, DSCR thresholds, maximum LTV thresholds. So I think it's fair to say that even some multifamily properties might not hit those, but certainly a lot of the office collateral will not hit those. So what does that mean in terms of maturities? So our expectation is that lenders and borrowers will work together to, likely modify the loans so they can qualify for those extensions. And at the end of the day, what most lenders are going to be looking for is just additional cash equity, additional investment from borrowers. So when we've spoken with issuers and collateral managers, there are different opinions on, all right, do we want the loan to be paid down? Do we want debt service reserves or leasing reserves replenished? Do we want to require the borrower to purchase a new floating rate cap agreement? There's different strategies depending on who you talk to, but at the end of the day, what that equals is hard money coming into the transaction. So whether it's, for performing loans or for non-performing loans or non-stabilized assets, our expectation is, we will likely see loan extensions be exercised and hopefully additional borrower investment across all of these properties.
Got it. Actually, we do have a couple more questions. You might be able to get to one more. How frequently do we review the performance of the underlying collateral?
So in-depth reviews we're doing twice a year, and that kind of helps me remember. John mentioned the surveillance report, so we're updating our ratings minimum twice a year, and every time we do that, we are publishing an updated surveillance performance update, which kind of shows the current composition of transactions. It has information on future funding that's been advanced and that which remains outstanding, information on loans that were added to managed transactions since the last DBRS Morningstar rating action, and then business plan updates for the 4 or 5 most pivotal loans in our opinions.
Okay, great. I know there are a few more questions out there. If folks can submit them directly by email, and we will make sure that we respond to you. So just to wrap things up, inflation has reached a 40-year high, and there's no doubt that the Fed rate hikes and the concerns that more could come have left borrowers and investors very hesitant in jumping into the market. And the question remains, how will today's higher rates affect outstanding CLO debt, and when will new issue begin to dust off that winter snow, and we might begin to see some blossoms? We'll continue to tackle these topics in future webinars and on our next quarterly CRE CLO report, expected to be published in April. I want to thank John and Steven for sharing their expertise, and want to thank everybody else for joining us today. Thanks, and have a great day.
Thanks, Steve.